Hello everyone, I hope that you're doing well. Welcome to this new lecture on no daily bias trading. This lecture will be a case study on a trade that I took on the 17th of June 2024. Let me show you the execution video before we begin. Here we are on the hourly chart of Nasdaq. Currently, we are seeing the market deliver in a rather choppy way. It's Monday and we saw the market take out both a buy-side liquidity resting above the Friday high right here, as we saw the market take out sell-side liquidity resting below this low right here. What we then saw was that the market consolidated. It went sideways. By itself, this is not significant at all. Why not? Because it doesn't make us bullish or bearish. We then saw this sudden drop lower right here after the 9:30 opening. We formed a low and we had this rather large wick get created for the 9 o'clock candle. 10 a.m. then opens up, and we see this delivery lower take place. But this delivery lower taking place by itself was something that offered a shorting opportunity, and that was the short that I took. Eventually, the market expanded higher, but that was not something I was interested in. Why not? Because based on this hourly chart, it was not clear to me whether or not we would be bullish or bearish for the day. That's what I outlined in advance as well within the market updates channel. There was SMT present on both sides of the marketplace, and I recognized the signs that we might be in a very choppy environment for the day. When those signs are present and it's not clear where the market is drawn towards, whether it be bullish or bearish, we only look for trades on the lower time frames, and these are scalps. So that is what this lecture is going to be about. You just saw the execution, and I'm going to break it down for you. What's very important to note that this type of protocol is basically what I'm teaching within the model series, but then without the higher time frame order flow aspect in play. Meaning you need to understand the full model that I'm teaching you within the model series in order to benefit properly from this lecture. However, don't worry, I will try to simplify it as well without going too in depth. If you are paying close attention to what I'm teaching you within the model series, then you're going to realize certain things that are hidden in plain sight when we're going to take a look at this delivery. Here we are on the 15-minute chart. As you can see, we have seen this very messy delivery from the opening with no real higher time frame order flow being in play. We went lower right here, we went higher, lower, higher, lower, higher. The market has just been basically going sideways for the whole day, trading around this opening price, the midnight opening price to be precise. The 9:30 opening comes along and things don't clear up at all. Instead, we see this sudden drop lower taking place, and we then see the market take out buy-side liquidity resting above this high. On the lower time frames, I will explain to you why this high was important to me. What I then anticipated was that we would retrace into the impulse leg from this low to this high, into a discount of that range. Why? Because if you take a look at the size of this wick right here, you can see this very aggressive wick, this very explosive wick. Look at the size. What you need to understand is that a wick is a gap, meaning the price range of that wick has to be repriced into. On the lower time frames, this wick right here consists of multiple imbalances. And what do we know? The moment that the market has formed a high after taking out buy-side liquidity, what can we target? We can target old imbalances. These are breakaway gaps. If we zoom into the lower time frames, I will show to you why these gaps are of importance. Here we're on the 1-minute time frame. What we can see is that from the 9:30 opening right here, we ran up higher, forming this high right here. We then had a sudden drop lower and a sell program was activated. The market retraced into the 9:30 opening price, into this CB, formed a new high, and the market expanded towards the downside. Then during our macro window, we saw a low formation and we saw a buy program unfold, targeting buy-side liquidity resting above the highs that got formed after the 9:30 opening. Because you need to realize that sellers were making profits on paper during this leg lower, meaning everyone that was short up here was making profit on paper. They trail their stops to all of the new highs that get engineered here, that get formed. Therefore, buy-side liquidity is resting above those highs. What was the key high that formed after 9:30? This high right here. Notice that we then run up towards this buy-side liquidity, and during that leg higher, we form this large imbalance right here, this 1-minute imbalance, this BC. Notice that even though we see this retracement leg taking place right here, we don't trade into this imbalance. This imbalance gets left open. When it occurs, this low becomes engineered sell-side liquidity. Sell-side liquidity which has been engineered above a key discount array. Why do I say, oh, this is a discount array? Because if we take a look at the range from this low to this high, we can see that this BC is in a discount. We can even see that OTE, the deep discount price range of any range, is also inside that BC. And because this is the case, this BC immediately becomes a strong drawn liquidity if we would look for a shorting opportunity. What did I wait for? I waited for this high right here to get taken out. Why is this high significant to me? This high is significant to me because it is the high that formed after 9:30. Right now we're trading between 10 to 10:30, so my eye is immediately always drawn to the high that formed between 9:30 to 10, the previous 30-minute cycle high. We run up higher from the 10 o'clock open, taking out that buy side liquidity, and then we saw the signs that confirmed to me that we would form a high. We consolidated right here. Notice we are going sideways, engineering more buy side liquidity. This is accumulation taking place. We then manipulate towards the upside, and at exactly 10:17 we form a high, boom, and we begin to distribute towards the downside. You need to understand that this fractal right here is an AMD fractal. We displace through this BC on the left side of the curve. Now this should function as an inversion value gap. Notice that we displace through it right here. You see this strong close below it. Next candle opens up, offers buy side, back into the open of this up close candle, boom, slams it lower into this discount BC. You might be wondering, what's the model that you're going to teach us then? The model that I'm teaching you is the following. Instead of aiming for the opposing side of the range, meaning targeting this sell side liquidity right here, if you would go short up here, what you're doing is instead of targeting that external range liquidity resting below this low, you target internal range liquidity. Internal range liquidity being the liquidity that is resting below this low right here, inside this BC. Why? Because this is the range we're working in, from this low to this high. And because we're working inside that range, all the key lows that formed inside that range are sell side liquidity targets that we could target. Sell side liquidity was resting below this low, below this low. Those levels can be potential draws on liquidity because the market doesn't just expand higher like that. It doesn't occur. Surely it might look like that in certain occasions where you would see the higher time frames just simply expand higher aggressively. On the lower time frames, you're always going to see retracements. And because I had no daily bias, meaning I was not bullish or bearish for the day, I simply wanted to target internal range liquidity. I wanted to target a certain level, or a certain range I should rather say, inside of a larger range that I know the market should retrace into regardless. It could expand through it. If it would expand through it, I don't care. If it's going to retrace into it and then run against my position, I don't care because I'm getting out inside this BC, and that's the thought process. I'm not aiming for a home run. I'm not aiming for the opposing side of the range. I'm simply being content with enough. If we go into the 15-second chart, we can see that there was SMT present on the highs, but not at exactly the high that formed at 10:17. We saw SMT form after we formed the initial high. Notice that we have this cracking correlation be present right here on the highs between Nasdaq on the left and ES on the right. Where Nasdaq created lower highs, ES created higher highs. Pay attention to the time here. What we then see is that on the 15-second chart, we displace through that BC that formed on the 1-minute chart. Notice that this price range is nearly similar to the 50-second imbalance that we can see right here. What was for me the short trigger? It was not simply, oh, we traded below this BC, now we should go short. No. What to me was the short trigger was the fact that we created in CB right here. Notice these Danko candles right here, they displace through that imbalance. What differs this wick right here from this leg, you might be wondering? It's the displacement leg. It's the sign of, okay, we're displacing through this range. Look at the bodies closing inside this BC here. That is not displacement. If you have been paying attention to the reviews lately, I have been putting a lot of emphasis on the fact that we need to see displacement above or below certain price ranges in order to confirm one-sided order flow. Wicks are not displacement. What is displacement is when we see the creation of an imbalance through, for example, this old imbalance, this BC on the left side of the curve. That's what I was waiting for. I then waited for the 1024 candle to open up, go higher, offer the shorting opportunity inside of this CB, and that was the trade idea. Took partials below this sell side liquidity right here, Why? Because this is an original consolidation and I eventually full closed inside of this BC right here. You might be wondering, what's so good about this trade? Well, if you would look at this setup, you could see that it offered nearly 30 points and I had no daily bias at all. I simply looked at, okay, what's the most logical thing for the market to do now? The most logical thing was that after we took out buy side liquidity, after we saw the signs of reversal taking place, we should now target sell side liquidity or a discount array. And that's the model. The model is simply trading from one imbalance in a premium to an imbalance in a discount. That right there is a model that works on every single day. It doesn't even require a daily bias, but the hard thing right here is that you need to be content with that run into that array. And if the market goes beyond that, you can't be worried about that. And that's the thing you need to understand when and where which model to apply. And over time, you will develop multiple models for different environments. And this is simply a model that you can utilize on demo accounts, of course. I'm not telling you to go there and trade for yourself. This is a model that can be utilized on days in which the daily bias or the session bias is not clear and in which you're anticipating range-bound price action to take place. Notice that after this trade was completed, I walked away. I didn't look for more, I didn't look for home runs, I didn't look for anything. I simply walked away. Why? Because I already got my nearly 30 points for the day. And that's all one needs. You don't need more than that, and especially when the environment is not clear, you can't be waiting after that initial trade has been taken and has been ended with a profit. Now, one thing that I want to touch on is the use of 10-minute cycles. You have just heard me utilize a 30-minute cycle high as a POI. Let me take you with me into a closer investigation of this smart money reversal right here. Because you need to understand that this right here is the original consolidation, buy side of the curve, sell side of the curve. Very messy market maker sell model. However, it's still a market maker sell model as I'm teaching it to you. Notice that this high formed at 1070. What I want you to do is I want you to pay attention to the following. From the 10 o'clock open right here, what I want you to do is I want you to divide the upcoming 30 minutes in 3 10-minute windows. Meaning I want you to place vertical lines in your mind at 10:10, 10:20, and 10:30. What I want you to see is how between 10 to 10:10 we ran up higher. Then near the end of 10:10 we consolidated once we took out that previous 30-minute cycle high, which has been annotated by this big black line. Notice we went sideways and eventually between 10:10 till 10:20 we ran up higher, manipulating above these relatively equal highs, taking out the buy side liquidity with this large upclose candle and then forming the high to displace lower. That right there shows that this is a purge on buy side liquidity. During the second 10-minute cycle of the first 30-minute cycle of the third 90-minute cycle of the morning session. Those are a lot of things to include within your analysis. However, the more you utilize time-based liquidity and the time cycles in thirds, I'm sure this will become easier over time. Because you need to understand that this is simply me dividing the times that we utilize in threes. And because we do so, we're able to have objective POIs. Those POIs do not change, those POIs do not move, no, those POIs are fixed. Meaning I already know for next week at which times and at what levels I'm going to execute based off. Here you can see two schematics that you can screenshot and put in your journal. The reason why I've created these schematics is because I want you to understand the overall logic that I've described to you during this lecture. What's very important to note that if we are looking at a bullish idea, a bullish trade inside of a day in which we do not have a daily bias, it will look like the following. We would see the market drop lower into our key level. From this key level, we would monitor to see if the reversal signs are present that we are looking for according to the rules described within the model series. This all has to occur during a certain time of interest as well. And the moment we displace higher, we are monitoring to see whether or not a BC will form. The retracement into this BC is our buying opportunity. What we would target is an old CB that formed on the left side right here of this curve. We would not target the high of the original consolidation, which would be around here. No. We would simply target this CP and the buy side liquidity which has been engineered below it. That's all we need. The moment we reach this CB right here, the job is done and we don't need to do anything else. Why? Because we're not certain if we're going to draw towards this original consolidation in respective high. It's possible, however, this is what you need to understand. When the daily bias is not clear and when you do not have a solid higher time frame drawn liquidity, it's better to be content with enough than having to sit through the falling. Where we would form a high right here, and instead of you taking either a big partial or full closing the position, the market rolls over and eventually takes you out, and the level that you thought to be the key level of which a low would form was actually not that significant, and the market just keeps on rolling over. For the opposing side, it would revert falling, where we would see the market reprice into a key premium array, a key premium level, at the right time, from which the reversal signs will become present that we're looking for according to the rules outlined within the model series. We would see this displacement leg lower, and a CB would form inside of this displacement leg. The displacement is the displacement below this low, and for the buy program, it's the displacement above this high right here. We displace through that level with a CB creation, we retrace into that CB, boom, that's a short. What do we target? We target a BC that formed right here on this run higher. This BC is usually in a discount of the range from the low that formed in this area to the high. The moment we reach this BC, this is enough and we need to be content with that because we do not know what's likely going to happen next. If we're going to rip straight through that imbalance or whether or not we're going to form a low there, to then reverse and maybe even draw higher. This model by itself is simply playing the range from imbalance to imbalance or from right here, imbalance to imbalance. That is all you need to understand. And if you understand this theory, you can also apply this to, for example, breakers. Trading from breaker to breaker. Or from mitigation block to mitigation block. Or from order block to order block. And this is how you can utilize PD arrays as entry opportunities, but also as targets. And these PD arrays form inside of a range. And this is how you can target internal range liquidity. Because sell side liquidity is being engineered above this BC right here, above this imbalance. Same on the left right here, where we can see buy side liquidity being engineered below this CB, below this imbalance. And that's how we can target internal range liquidity. And we do not need to have a daily or session bias for this. All we need to know is what is likely going to be the next drawn liquidity. Have we taken out buy side liquidity? Are we seeing signs of the market reversing and topic? Okay, then we can anticipate the market to retrace on the higher time frames and just target sell side liquidity, a discount array. With that being said, this lecture is completed. Please investigate on your own this model. It's very simple when it comes to the outlining of it. Why? Because you need to understand that all it is trading from an imbalance to an imbalance instead of trading from an imbalance to the external range liquidity, as I'm teaching within the model series. But that's the only adjustment that has to be made. It's simply that right there. It's the adjustment of the drawn liquidity based on the environment that we're in. And this is not a bad thing to do, because if you're not sure about the environment, it's better to be content with enough than having to see the market reverse at a potential area where you could anticipate the market to reverse and draw again towards your entry and to your trail stop. I hope that you found it insightful, and I look forward to catching up with you soon. Be safe.